the ultimate destination for smart investing. Welcome to Invest Ideas, where we turn your financial dreams into reality. Subscribe now and join us on the path to financial freedom. Hey there! I see you're interested in hearing about financial crises and how to protect yourself from them. Well, you've come to the right place because I'm here to tell you all about it. Now, we've all heard the saying that each crisis is more dangerous than the one before, right? And here we are, in 2023, getting closer and closer to a point where the crisis is bigger than the Fed's ability to stop it. Scary stuff, huh? It's like a game of Jenga, and we're reaching the point where one wrong move could cause the whole tower to come crashing down. But don't panic just yet, my friend. It's impossible to know exactly how close we are to the crisis because, as they say, it's a complex dynamic system. We can make good predictions, but we can't pinpoint the exact timing. What we do know is that we're uncomfortably close. And that's because we've been there twice before, in 1998 and 2008. Remember 1998? It all started with a Russian default on their external debt and the ruble was grossly devalued. This sparked a global liquidity crisis that went around the world and ended up at long-term capital management, where they had $1.4 trillion in derivatives. Now, you might think they lost a lot of money in Russia, but they only lost about $100 million there. The real losses came from everything else. In a liquidity crisis, people sell everything. It's not just about Russian bonds. Spreads widen, there are not enough collateral margin calls, and people are blown out of their positions. That's what a global financial crisis looks like. Luckily, we managed to cure that crisis with a $4 billion oil cash injection sponsored by the Federal Reserve and 2 rate cuts, one on an emergency basis by Alan Greenspan. But we came within hours of shutting every market in the world. The same thing happened in 2008 when Lehman Brothers failed. People don't realize that Morgan Stanley was days away from failing, and Goldman Sachs was too. The Fed came in and stopped the dominoes from falling, but each bailout gets bigger than the one before, and each crisis is more dangerous than the one before. So, what can we do to protect ourselves? You want assets that are immune from a global liquidity crisis. What are they, you ask? Land, real estate, gold, silver, fine art, natural resources, water, energy, and oil. If you want to be in stocks, get stocks of companies that are based on natural resources, such as ExxonMobil and Chevron. Don't just stick to a regular stock portfolio. Banks and money market funds are going to be in distress, so be careful. And here's a fun fact for you, the dollar has been cryptocurrency since at least 1979. That was the last year the Treasury issued a paper Treasury note. Maybe somebody's grandmother still has one in the attic, but you won't see them around anymore. Message traffic has been encrypted since around 1980, but in terms of the impact on the dollar, be careful what you wish for. Economic sanctions can be powerful, but if you use them too much and too broadly, they lose their impact. People will say, okay, no mas, I'm out of the dollar system. We've never frozen a central bank before, but we have now. We've never kicked an entire country out of SWIFT with the exception of Iran, but now we've done it with Russia. Instead of just sitting there and saying, oh gee, you got me, we can say, okay, let's go to a new payment system. And that's where cryptocurrencies come in. They offer an alternative to traditional payment systems that can be controlled by governments or centralized authorities. Bitcoin, for example, has a limited supply and is decentralized, meaning that no one entity controls it. This makes it an attractive option for people looking to protect their wealth from a potential financial crisis. But it's important to note that cryptocurrencies can be volatile and risky. They're a relatively new asset class, and their value can fluctuate rapidly based on market sentiment and news events. So, if you do decide to invest in cryptocurrencies, make sure you do your research and only invest what you can afford to lose. One important thing to note is that financial crises often have a domino effect, where the failure of one institution or market can quickly spread to others. For example, in the 2008 financial crisis, the collapse of Lehman Brothers led to a freeze in the credit markets, which in turn impacted banks, businesses, and individuals who relied on credit to operate. This domino effect can be difficult to predict and control, making it crucial for individuals to be proactive in protecting themselves from potential financial crises. One way to protect yourself is to have a diversified portfolio. This means investing in a mix of assets such as stocks, bonds, and alternative investments like real estate or commodities. Diversification can help reduce your risk because if one asset class is negatively impacted by a crisis, your other investments may be able to offset those losses. However, it's important to note that diversification does not guarantee a profit or protect against losses in a declining market. Another way to protect yourself is to have a strong emergency fund. This means having enough cash saved to cover your living expenses for several months in case of a job loss or other financial emergency. An emergency fund can help prevent you from having to sell your investments at a loss during a crisis, which can make it difficult to recover financially. It's also important to consider the impact of inflation on your investments. Inflation is the rate at which the prices of goods and services increase over time, and it can erode the value of your savings and investments. One way to protect against inflation is to invest in assets that tend to perform well in inflationary environments, such as commodities like gold or real estate. Additionally, investing in stocks that have historically outperformed during times of inflation, such as those in the energy or materials sectors, can be a good strategy. Another strategy to protect yourself from financial crises is to focus on investments that generate income. This means investing in assets like dividend-paying stocks or bonds that pay interest. These types of investments can provide a steady stream of income, even during a crisis, which can help you weather the storm and avoid having to sell your investments at a loss. It's also important to be aware of your own risk tolerance and investment goals. While it may be tempting to chase high returns, it's important to remember that higher returns often come with higher risks. If you're close to retirement or have a low risk tolerance, it may be more appropriate to invest in more conservative assets that offer lower returns but also lower risk. On the other hand, if you're younger and have a higher risk tolerance, you may be comfortable taking on more risk in pursuit of higher returns. Finally, it's important to stay informed and educated about the markets and the economy. This means reading financial news and analysis, staying up to date on economic indicators, and regularly reviewing your investment portfolio. By staying informed, you can better understand potential risks and opportunities, and make informed decisions about your investments. In conclusion, financial crises can be unpredictable and have wide-ranging impacts on individuals and the economy as a whole. While it's impossible to completely eliminate the risk of a financial crisis, there are steps you can take to protect yourself. These include diversifying your portfolio, building a strong emergency fund, investing in assets that perform well in inflationary environments, focusing on income-generating investments, being aware of your risk tolerance and investment goals, and staying informed and educated about the markets and the economy. By taking these steps, you can help protect yourself from potential financial crises and better navigate the ups and downs of the market. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Until next time, happy investing.